Bismillahirrahmanirrahim. Wishing all my viewers a very happy and blessed Ramadan. In this video, we will talk about convertible bonds. We will talk about what convertible bonds are, the key features of convertible bonds, what is the conversion mechanism, the advantages to the bondholder and the benefits to the company, why an investor should invest in convertible bonds. We will explain two different scenarios on convertible bonds. And finally, we will talk about the risk of convertible bonds. Please like, subscribe, and share my channel to search for accounting lessons and hit the notification bell button to alert you for the latest video. For all of your questions, comments, and suggestions, please put them in the comment section below. And for webinar and guest speaker invites, please send me a message at accountingamir@gmail.com. Accounting is AK. We hope that this video helps students in their academic development and teachers in enhancing their lesson plans and teaching methodologies. So let us start with the topic, that is convertible bonds. Now, convertible bonds are a type of hybrid security that combines features of both debt and equity. Essentially, they are the bonds issued by a company that can be converted into a predetermined number of the company's shares of stock at the bondholder's discretion, usually at specific times during the bond's life and at a set conversion price. So let us break it down to see how the convertible bonds work. Coming to the bond characteristics, now they are like regular bonds. They pay interest called the coupon and have a maturity date. They are a form of debt that the company needs to repay, that is the principal plus the interest, unless converted into stock. The bondholder has the option to convert the bond into shares of the company's stock at a predetermined conversion ratio. The conversion ratio tells us how many shares the bond can be converted into. For example, a 1000 bond might be converted uh, into say 50 shares. So the conversion price is 20 per share. The conversion price is sometimes set at a premium also over the current stock price when the bonds are issued. Now, this is because the investors are willing to accept a lower coupon rate in exchange for the potential to benefit from future stock price appreciation. Now, these are the advantages. There is an upside potential if you acquire a convertible bond, because if the company's stock prices rise above the conversion price, the bondholder can convert their bonds into shares, potentially making a profit. Now, if the stock price doesn't rise or fall, the bondholders still receive regular interest payments and can hold the bond to maturity, receiving the principal back. From the company's perspective, convertible bonds can be attractive to companies because they often have lower interest rates compared to regular bonds. Now, since the investors are willing to accept lower yields in exchange for the option to convert into equity. If the bonds are converted into stock, the company doesn't have to repay the debt in cash, which can help its cash flow. Coming to why we should invest in convertible bonds, one is that there is income and growth. Investors get regular income from the bonds interest payments, and they have the potential for capital appreciation if the stock price rises. They offer the ability to convert the equity if the company performs well, but the safety of a bond with regular coupon payments if it doesn't. Let us look into an example like we have a convertible bond of 1000 with a 5% coupon rate and a conversion price of 20 per share. So if the stock price rises to say 30 per share, you might convert the bonds into 50 shares, that is 1000 divided by 20, and this will give you a gain. Now if you decide not to convert, you will continue to get the 5% interest on the bond until maturity. Now these are the risks if the stock price doesn't rise. So if the stock price stays below the conversion price, you may not want to convert the bond to stock and you will just receive the interest payments. Like any bond, convertible bonds carry the risk that the company could default. If many bondholders convert into equity their bonds to stock, it could dilute the ownership percentage of existing shareholders. So, in summary, convertible bonds offer a blend of safety, that is, bond like features, with the potential for stock like returns, but they come with both upside potential and risk based on the company's performance. So this completes the video on convertible bond. I hope you have enjoyed the presentation, and if you found value in this video, then please like, subscribe and share my channel and hit the notification bell button to alert you for the latest video. For webinar and guest speaker invites, please send me a message at accountingamir@gmail.com. Remember, effective questioning brings insight, which fuels curiosity, which cultivates wisdom. If you have any question or any suggestion regarding this session, then please put them in the comment box below or by email, and inshallah I will reply you back. Thank you so much and happy learning.